Hey, this is Rod Cleef, and you are listening to the Mailbox Money Show with Bronson Hill.
All right, so it's time to cover your assets, right? It's important as a passive investor. You know how to protect yourself, especially if you're a higher net worth person, you have a business, you have multiple investments. If you don't, you are a walking liability. Everywhere you go, you could back the car out of the driveway and hit the neighbor's kid, and all of a sudden, all of the assets, all the things that you had protected in an entity or even in your investments, they're all at risk. And so, one of the challenges of our legal system is that anybody can sue anybody. And so it's important to be able to have some legal protection in what you do. So my friend Mauricio Raud is awesome. It's a great interview talking through how do you protect your assets, what's happening in the current environment, what are some lessons we can learn as passive investors or operators. Because again, if we don't learn, we're just simply going through the same things. We don't really have a chance to step back and say, this is the learning from this, right? And it's easy when a deal goes bad to blame someone else, but the learning is to say, well, what can I learn? I chose to invest in this deal, so what can I learn here? Right. So those are all things we're going to jump into. I think you're going to like it. All right. Welcome back to the Mailbox Money Show. I am super excited to be here with my good friend Mauricio Raud, who's on the road in a hotel, speaking all over the country. He's the attorney everybody wants to talk to because he speaks English, and he's an amazing guy. Welcome, Mauricio. How you doing, brother?
It's great to be back, my friend. Looking forward to this episode.
Me too, man. I know you have some news. You've got a new book out.
I do. I got it right here. Actually, it's my first. I've written a couple of chapters in a couple of books, and you may have as well with our buddy Kyle. But this is the first full-fledged book, Legal Strategies for Everyone, that our mutual friend Ken McElroy asked me to write. I'm one of his legal advisors, and so he's putting out a series of books called the Strategies book series, the Strategy series. So Kenny's doing a real estate strategies for everyone. I'll do the legal strategies, and then Eric does the tax strategies. And it's going to continue with more, sales strategies. So it was a fun process for me. I've never written a book from scratch. It's a lot more involved than I thought it was, but at the end, I'm super proud of it, and I can't wait to write the next one.
Well, I want to hear more about that. I just made a decision. Tony Robbins has this quote. He says, "It's in your moments of decision that your destiny is shaped." So I decided to write a book at a Tony Robbins event, ironically, almost 2 years ago. And then just 2 days ago, I made a decision. I'm going to write another book. I'm going to a book camp and going to write another book. So I'm thinking of, invest in yourself or the passive investing myth and getting into more of the, stuff about investing. But I had a method that I used to write my book where I'd set the timer for 60 minutes 5 days a week, and I would just write. I would just stay there and write for 60 minutes. By the time we're off, I'd be done, and I go into something else. But then a couple months, I pretty much had most of my book done. But what was your strategy to write? How did you kind of schedule that?
You need to write a book called "Writing a Book Strategies for Everyone" or something like that. Like I am the worst. Everybody thinks I'm super disciplined. I'm really bad at discipline, and so no. I am a procrastinator. So this waited till the absolute last minute. I think I had like 5 weeks or 4 weeks, three, whatever it was. Like I was really stressed. And I had the outline. So my thing was I started with the outline. So I knew all 10 chapters. So I had an idea, oh, well, this chapter is going to be on estate planning. This chapter is going to be on introduction to asset protection. This chapter is going to be on insurance, whatever. But then it was like, okay, well, I got to write it. I've got 10 weeks to go. And that means I got 1 week per chapter. And then so I literally crammed it all at the end and just, and that's what lawyers do. And I did that in law school. I did that in the law firm. I mean, we pulled all-nighters all the time. I mean, we are literally when I act best. I don't like doing it, but I usually act best when I'm really crunched for
Under
time,
pressure.
really
Yeah.
efficient. And it's no difference with the book. And I got it in right under the wire. And so yeah, there's definitely, I'm not recommending that strategy for everyone, but
Yeah, well, I think it's good. A lot of people listening may want to write a book someday, and it's just like, how do you write a book? And there's different methods, and of course, we got the method I mentioned. There's a method you mentioned, and if you give yourself deadlines, and I got to get it done, whatever, and you just got to do however you got to do it. So I think if you commit to it, it can be great. But so tell us, legal strategies for everybody. One thing I've admired about you is you're able to break things down in a way that everybody can understand. And we say, you're one of the few lawyers that actually speak English, because a lot of lawyers are good at making things as complex as possible. But tell us, like, what are some things from the book that people will get when they pick it up?
well, I think you're right. So, for example, one of my favorite quotes right now that I'm using is it's really what's caught, not taught. So just because somebody teaches you something, if you don't actually take it in and take notes and capture it, it doesn't really matter if all the information come your way, but you got to be able to articulate it. So that is one of my things. I spent a lot of time, as Bronson, before I was full-time syndication attorney, I was a pretty prolific asset protection attorney. So I'm one of the foremost experts. I don't do it anymore, which is a lot of fun because I don't have a dog in the fight. Like I'm not here to sell you an LLC or a series LLC or anything. So a lot of this is about asset protection. But I think especially for your audience, which are sort of either passive investors or real estate investors, it's really, really important to understand this idea or this concept to sort of separate yourself from the asset. John Rockefeller, I think it was, who said, own nothing and control everything. And that really is the overarching principle of asset protection. You want to make sure that when you're investing, whether it's real estate or any other asset, or you have a business, you want to make sure that that business and that property is being conducted in a separate legal entity, separate from yourself. That way, if something does happen, something, God forbid it happens, but you know what? It is going to happen. So if you're a real estate investor, guess what? Tenant's going to slip and fall, your boiler's going to explode, some horrific thing's going to happen, hopefully not catastrophic, but those do happen as well. I'll tell you stories some other time about the things I've heard of on apartment buildings, of things that have happened. But you want to make sure that when that happens, you are protected, meaning that the liability is really limited to whatever structure, LLC or corporation, if it's a business. You want to make sure that that liability is not going to extend to you personally, because you want to make sure you hold on to your hard-earned wealth. And that really is what asset protection is. And what I think most people forget, and this is kind of the overarching principle, is that when you're thinking of asset protection, and let's just use real estate, because most of the audience here, and that's what you and I specialize in, there's really two angles to things that people have to think through. One is the inside attack, right? Something happens to your property, as we just discussed. And in that scenario, there's a set of principles and a set of things we can do. But in addition to that, we have to worry about the outside attack, meaning something happens to you unrelated to your property, unrelated to your business. You get into a car accident is the classic example. And now there's a judgment against Bronson. I'm going to pick on you, Bronson. I have a judgment now against Bronson, unrelated to all your real estate holdings or all your assets. And now I want to go execute and actually collect on that. And that's where a different set of principles, that's where you hear things like charging order protection. That's where you hear things like Wyoming entities and Nevada entities and Delaware entities. So depending on what angle I'm looking at, or what I'm trying to address, we'll have different strategies to do. But at a very minimum, you want to make sure you do not hold your properties in your personal name. A lot of people do. Or another interesting thing that people do is they create the LLC for their properties, but they never actually get around to transferring title from their personal name and transferring it to the title of the LLC. But at the minimum, you want to have that, because otherwise you have what we call unlimited exposure. So no matter how little equity is in your home, if something catastrophic happens in your property and you don't have insurance, or the insurance isn't enough, then it doesn't matter that there's only $100,000 in equity in the property, or 50,000 or 200. You're going to have an unlimited. You could have a multi $100 million judgment against you, and you're going to be on the hook for that.
Yeah, no, that's interesting. We talk about that with a lot of our investors about asset protection. And again, there's some people that have a net worth of 50 million and they're not working anymore. And it's like, okay, obviously I need some asset protection here just because I'm a walking liability. I could back over, the neighbor's kid, or, you just never know. And then all of a sudden you have all this, and there are people, especially where we live in California, that are just go after people with assets, that just find a way to just cause, sue them. And you can sue anybody. That's the downside of our legal system. But what is I guess, because again, some people just starting out, I've seen people, I've got a 50K net worth and I got to set up all these things. And I'm like, well, I don't know if it really makes sense at this point, but what's the timing to do that, and what levels, because again, if somebody's 50K is like, okay, maybe you do an LLC, but you don't do these other things. And then, what are some of the things people do, and maybe different thresholds?
Beautiful question. I actually talk about these in layers. I talk about like the 6 layers of asset protection, because you're right. If you're just starting out, if you have a W-2 job and this is your first ever rental property and it's a little duplex and you're putting 10K down or no money, whatever, that's going to look a lot different than your example of now I'm retired, I'm a $50 million in net worth. I mean, that's going to look a lot different. You're not going to set up a fancy offshore asset protection trust, fancy all that stuff, if you're the W-2 guy or gal who just bought their first property. But on the other hand, insurance alone is not going to cover the guy with 50 million, right? So it really does depend, to your point. But I think it all starts, first of all, insurance. I think that's your first layer of defense, no matter what. At a bare minimum, you want to have insurance. Everybody should have insurance to be your first layer of defense. Now, I hate insurance companies. Maybe hate's a strong word, but I have a lot of issues with insurance companies for a variety of different reasons. And so you need a backstop in the event that the insurance either isn't there because there's an exclusion, which is one of the issues, right? You think you're covered, turns out that you're excluded, or it just the number isn't enough. You only have $1 million policy or a $500,000 policy, and this is a $10 million judgment. in the event the insurance isn't there, you want a backstop. And that backstop is the LLC, the limited liability company. So at a bare minimum, I think an insurance policy covered by an LLC, if nothing else, that would be your first layer, your first step for somebody who's just starting out. Now, as you accumulate more and more properties, you start getting a little bit more complicated. You start having multiple LLCs. And that's where I would start worrying about setting up LLCs in states that are really, that are advantageous to you. So you hear about these, I love Wyoming myself, or Nevada. Yeah. They have what's called charging order protection, which is really, really important because it's a situation where if somebody does end up suing you, Bronson, personally, and they want the judge to hand over those LLCs to say, I'm suing you, to me to satisfy my judgment, the judge is not going to do that. They're going to limit me to a charging order, means I'm just going to get your financial distributions that you would have received, but I'm not going to get control of your assets or either ownership of the assets. So that's a big deal, but that doesn't really happen until you get a little bit more involved. And then, of course, as you get more and more sophisticated and more, when your estate grows, right? Like you gave the example of the $50 million guy, that's when you start looking at asset protection trusts, which are really the gold standard of asset protection. The problem is they're just expensive.
It
doesn't make any sense to go spend, $30,000, $40,000, $50,000 to set up an offshore trust and pay a trustee. And when you're only trying to protect $100,000 or $200,000. So depending on how likely it is that you're going to get sued, a doctor, for example, is going to be a much higher liability than, a completely passive investor who really doesn't do much other than passively invest. So it just depends on a lot of those factors, but you're right. It does depend on where you are in your life and your career, and you just got to build upon that.
Yeah, it's interesting too. There's kind of this asset protection, based on, your level, you have activity, how much privacy you have. It's the nice thing about these private deals. If you're a passive investor, it's not disclosed. People don't know that you have millions of dollars invested in deals, which is great. It's another thing that's awesome about passive deals. But let's talk a little bit about, I want to shift a little bit, talk about kind of what's happening now in the investing environment. We've seen, rates rise the fastest we've seen in over 40 years. I know you actually have a podcast, Drunk Real Estate, where you guys chat with a bunch of awesome dudes and you give updates on economics and all that. So you guys have conversations around this, but I know you're seeing it from both sides. You're seeing it from operators that have struggled, and you're seeing it from investors that are going through deals where there are potential losses or capital calls. Can you speak to just kind of what that looks like and how, kind of the environment you're seeing and kind of what investors can do in this, And
as you know, my bread and butter is I represent, GPs or sponsors. That's really who my clients are. But I'll tell you, the LPs, which are the investors, the passive investors, they're pissed. I think you may, I don't know if you were there, but I was at the Best Ever conference and there was a whole day on LP. So I got a lot of feedback from limited partners, and they're upset because not only are deals not going well, obviously, which is something that you don't necessarily can control, but more importantly, a lot of the GPs, obviously we have had a lot of cash calls, which obviously nobody likes cash calls, but there's been a lot of cash call requests because people need more capital. But GPs have tended to kind of disappear in this time of need. That's the feedback I'm getting from LPs. So, something isn't going great. Okay, everybody understands, but the level of communication between the GP to their investors has really gone down. And that's unfortunate because I always preach, and I got this from my buddy Kenny McElroy. He says, communication builds trust.
Yeah.
So when things aren't going well, that is the time to double, if not triple, your communication with your investors. And unfortunately, a lot of sponsors are literally sticking their head in the sand and not only not communicating with their LPs. We were talking a little bit about this offline as well, but also I'm getting a lot of people talking to me about some of my clients that they're cutting off communication with their co-GPs. Meaning there's a lead sponsor, right? There's a lead sponsor involved. Not communicating or actually cutting off meeting access or document access to their partners. And so that's separate and apart from whether, hey, interest rates. I mean, I think everybody understands interest rates have gone up, not only gone up substantially, but in the timeline that they've gone up so fast, so quickly, that a lot of people got off guard. The insurance policies that people are buying, these rate caps, those are expiring, or maybe they weren't covering. Again, nobody expected them to go this quickly, this fast, go up this fast. And so I understand there's some distress, but I think LPs are a little upset, or a lot upset, because of the way they've been handled, not getting access to information, not getting access to communications. So that's something that I think will come back to bite a lot of sponsors, because they remember. I don't know if you're a GP listening to this, I will confide that there are a lot of LP only groups out there, whether they're Facebook groups or LinkedIn groups. They don't let in any of the GPs. It's only limited others, and they talk amongst each other. And so when one sponsor is doing something that it gets that message gets around. And so I just think it's going to be, if you have a chance to over communicate, I would do it, because otherwise it's going to affect your ability, I think, to raise capital in the future, because word's going to get around. It's like, hey, this is the guy that when things didn't go well, instead of handling it a certain way, with communication, with doing everything possible, we just never heard from him or her again. That's going to, I think, make it harder and harder for sponsors to raise capital the next cycle.
Yeah, I agree. No, it is really, and as a GP who's been through a couple of deals that have struggled, it's, it is more worry. You get these calls and it's uncomfortable. You get people, hey, what's going on? How secure is this, or what's going on? But I think this is, it's funny. I was a youth pastor for like 5 years, and you have a lot of deep conversations over there talking about spirituality and talking about God and things like that. But when it comes to money, these are deep conversations as well, because people that, have, a potential loss or are going through stuff. I mean, if you're there and you can help people, even if you're not, it's not good news, like you said, Ken, our friend Ken Macker, is delivering bad news, or, bad news early builds trust, and really having hey, this is where we're at. And this is what, and if those listening know Ken, I mean, he's just a what you see is what you get kind of guy. Like, he doesn't really sugarcoat it, and he's, oh, what's going on, whatever. And I think that's how we can actually get better. And I've seen a lot of investors as well. I think there's a lot of lessons here, both for GPs and for LPs. And I think the tendency as an LP is like, well, you guys lost, or you may lose money, or you lost money, so it's your fault. But the issue is, like, as an LP, I chose to invest in this deal. So I have to say, well, what did I learn? And I'll say, for me as a GP and an LP, I've learned I don't want to do any more real estate deals without fixed long-term debt, 5 to 10 year debt. I don't want to do any more of this 2-year stuff, because sooner or later there's going to be another situation where rates rise quickly. And even though 2010 to 2020, like, it was, you were a genius if you owned property, it didn't really matter, you were just there. But the tide has come out, and you can see who's been swimming naked. So it's important to say, oh wow, like, there's something I can learn here. Can you speak to that? Just the idea of the lessons that we can kind of see along the way.
You're starting to see it already. I mean, the lessons are, people are starting to focus on areas of, say, the operating agreement or the structure of the deal that they wouldn't even pay attention to 2 years ago. But I think on the next round, they are starting. So, for example, the cash call provisions is obviously a big one this year that's going around now. So in the past, nobody really knew or paid attention to the cash call provisions. But obviously now, even our clients, when they're needing to do, or even thinking about doing a capital call, they'll reach out to us and say, hey, we need to raise more money. What do we do? Or how do we do it? And I said, well, we got to look at the operating agreement. So that applies to everyone. So if you're thinking about doing a cash call, step one is pull your operating agreement. And if you're an LP too, you pull your operating agreement and look at the process. There's going to be a section in the operating agreement that lays out the step-by-step of how to do a cash call. And some of them they're all different, right? So some of them have big dilution provisions in there, so that if you don't contribute a capital call, your interest in the deal will dilute. Others give more power to managers to go get loans from outside companies and really dilute you. So you've got to really pay attention to those. And then the other provision people are paying attention to a lot is this communication part. So there's always a section in there that says what kind of reporting does the sponsor have to give their investors? And everybody's just like, oh, I'm just going to get a report every quarter. Now I'm hearing LPs say things like, well, now when I'm investing with a sponsor, I want to see a copy of the types of communications or the types of reports they've been giving in the past. And now I want to actually see the type of reporting. Am I just going to get a one-page Word document that says, hey, things are going great, here's your money? Or am I going to get a really detailed breakdown with pro formas and how it should have been going, how the actual, and that's becoming something important, where 4 years ago, nobody cared. They just knew some provisions in there. And so little lessons like that, I think people are starting to focus on parts of the deal that they wouldn't have thought about, a few years ago.
Yeah, I think that's really true. I think that, it's the learning, right? It's the investing in ourselves as well. It's the growth that happens while we learn, because some things go well and we learn when things don't go as well. And I think the sponsors, especially that, really communicate well. I think, I would talk about two things. There's performance of a deal, and there's communication. And the performance can be great, but if the communication is terrible, it's not a good experience. People don't reinvest. And if the communication is great, but the performance is terrible, it's like, well, that's great. You're reporting all the time on something that's just like a turd, it's not working.
And don't forget, like, if you're an LP, think of it from the sponsor standpoint, but think of your LPs, they're probably invested in multiple deals, right? And so it's going to be rare for you to have an LP now that hasn't had an issue with their deals, like at least a cash call or some trouble, whether they lost a deal or lost money, maybe not, but they're going to have an issue. And so they're now learning, like, hey, I know you people lose money. I understand that, but then how do they handle that on the communication? And I think that is going to be something they're going to be looking at the next time around. So be prepared to answer those questions. Hey, how did you communicate? And they're going to talk to your other LPs like, hey, how did Bronson do that last time things weren't going perfectly? Did he communicate? Did he not do? And if the answer is, dude, I couldn't get a hold of this person and they just disappeared, that's going to affect you. So I just want people to be aware of that, because it is going to be part of the conversation on the next capital raising cycle.
Well, and it's funny. It's interesting too, going through it both as a passive investor and seeing a deal struggle versus also being a GP. I mean, when I think it's very glamorous. People are like, oh, you raise all this capital and you do this and it's great, whatever. And then, if you're somebody who raises capital and you've got partners, and our goal is to basically, obviously we have fund to funds, we're co-GP on some things, so we're involved. But my goal over time is to like own everything and really operate nothing, right? Just kind of be more like being able to travel and do this stuff. But when something's not going well, those are very different conversations, and you kind of go from being a hero to being a zero in some people's eyes, and it's a struggle. And I've watched different, you kind of get to see what someone's character is when something's going difficult. I've seen co-GPs I've had on a deal that struggled where I've really seen them shine and just really come forward. And I've acknowledged, man, like, this is really awesome to see you just come forward and really like the way you've presented yourself. But other ones, like you said, they hide, they run away, they blame, they do other things. I've even found, actually, I know, I'll give an example. I won't share who it is, but there's a passive investor I know that invested $700,000. I think pretty basically like almost a first time investor or a very new investor in a deal. It had a loss of, I think most of the capital, or potential loss of all the capital. And this guy said, he's like, well, I trusted this co-GP. It wasn't me, but trusted this co-GP or this sponsor. I trusted that they're the expert in this. But as a limited partner, you can't just trust someone else with your investments. That, I think it's been said that no one cares about your investments the way that you do. And that's why the education piece is so important. What are some ways you found that, people can grow their education in this space? I know there's many ways, but what are some ways you recommend?
I mean, let me just make a quick point about that, because as a passive investor, obviously, once you make the investment, there's not much, you're along for the ride, but all of your work has to happen at that, when that trust part is, that's where your due diligence really had to kick in. Like, you had to do your due diligence on the particular sponsor, not only the co-GP they were talking to, but who's the lead GP, what is their level of experience, what is their level of experience in that particular asset class. I mean, there's so many things that you should be looking at, because once you write that check and leave, you've got nothing to do. So you can't blindly trust somebody. Maybe the first time when you do all that work, and the friend, like when you spend a lot of time doing your due diligence the first time, and you get to know them and you're comfortable with, and then maybe the second time, well, I've already done the due diligence, I can trust them because I've already done the work. But to blindly send your money over there without doing any due diligence, I would say there's some fault there on the LP side. And LPs have to understand that, just like any investment, there's risk, and that nobody's going to bat 1,000. And so there's an argument to be made that you want to diversify your LP investments. Hopefully you have 10 LP investments out there, and maybe 1 or 2 of them didn't go well, but you've got the other 8 that are doing okay in the different asset classes. And then from an educational standpoint, I mean, look, I don't want to get too fancy on this. I mean, literally, the advent of YouTube and all of this, I mean, nobody's dying for information these days, like whether it's a YouTube or Google. I mean, there are ways for you to get educated. You don't have to go to a fancy college or university anymore. Like, you can get all of this amazing. In fact, you can actually get courses that are like, I've taken courses at Harvard that are just on YouTube, like literally courses on YouTube. So when you're trying to educate yourself, if you're a brand new LP, or maybe you said, look, I've been trusting people, I want to learn a little bit more about what I can do. I mean, I've even put out content, and I represent sponsors, but questions to ask, sponsors prior to investing. I know a lot of people have done that. So it's not that difficult if you put some time into it to just find that the information is out there if you want to go find it.
Yeah, exactly. I mean, I think that's the issue. And again, it comes down to just a personal development, for taking full responsibility for your life, right? And for what you want to do. And it's always easier to blame, but then we don't learn. So,
and by the way, before you go on, I want to commend you on saying that, because you did mention, like, look, you can either blame somebody else or you can learn from it. And I think those of us, and I know you're being in personal development like I am, we not only like to take responsibility. There's a great book called Extreme Ownership, right, from Jocko Willink. That's an amazing book. But I mean, you got to learn from it. That way, it'll enhance your next time around, and you'll learn. If you can learn from these mistakes, or whatever you want to call them, then you're much less likely to fall into that mistake the next time, and then you can continue to grow your portfolio. So anyway,
he actually gives the example. There's 2 investors that, you've been to our local meetup here in Glendale, California, but years ago we had a meetup, and the speaker had asked, his name is Jay Massey. He does a lot of stuff in the short-term rental space. And he said, how many of you have lost, maybe we're 50 people, how many of you lost more than $100,000 in a single real estate deal? And it was like, maybe a few hands go up, maybe he started with 50,000 and a few, 4 or 5 hands go up, whatever. How many lost more than 100,000? How many lost more? Just keep your hand up. And then we got all the way to like, how many lost more than $500,000? And then he said, how many lost more than $1 million in a single real estate deal? Just like, I'm like gasping. Oh my gosh. And just 2 hands up. And it's Jay Massey and then Christina, who's the co-leader of that. And they're both high net worth people. So, but it's all learning. If we allow ourselves, I lost $70,000 in one day in an options trading strategy, right? It's a little embarrassing, but it happened. And I learned from it. I learned I'm not a good options trader, right? So I learned the things that I need to learn. And obviously there's different lessons that we have. So awesome, man. Well, how can people, I know you've got all kinds of stuff you're doing. You're tied in with Brandon Turner and Ken McElroy and all this stuff. What are some things, what's kind of next for you? I know you've got your book you're promoting. What are some things that you're developing and just some ways people can kind of connect with what you're doing, Mauricio?
I mean, I'm really focusing on the sort of as you said, I love the teaching and the education, and I do have that. I've just accepted it. People tell me it was like my secret sauce or whatever. It's just something I'm really good at, taking complex matters and making them easy to understand. So I'm really doubling down. I've got now 2 podcasts, and I'm talking about doing a third. So I've got Drunk Real Estate with my co-host Jay Scott and AJ Osborne and Kyle Wilson. Not that Kyle Wilson, Ashley Wilson's husband.
Kyle Wilson.
And the other Kyle Wilson. And then I got my own podcast, the Real Estate Syndicator Live, that right now is on YouTube only. And I'm planning to then move that over to also a podcast platform. And then I'm in some discussions with others to do a third podcast. So I'm really trying to really grow the sort of the media side of it because I think that's the best way to serve. I think it's a win-win for everyone. You add value to the community, and then also that indirectly helps me in so many different ways, whether it's financial or just from a personal development standpoint. You know this because you do this as well, but the amount of energy and satisfaction and a sense of accomplishment that I get after spending an hour just doing an AMA with people. I do AMAs twice a week and like for an hour, and there's like 40, 50 people on there, and they'll just grill me with questions, and all I do is answer them. I get so much satisfaction and personal growth from that. I think I get more out of that than the people that actually show up, and they get a lot of value out of it. So I'm going to continue doing that. We're looking to we're obviously not obviously, but we're scaling our company, trying to get from 7 to 8 figures, and really enjoying building that. A lot of personal development involved in trying to scale. There's stuff you need to do to get your business to 7 figures, and then there's something different you need to do to multiple 7, and then getting to 8 figures. Like I need to become somebody more. I need more. I need to read more, get more coaches. I've got a lot of personal development to get me to that next level there. So I'm excited about doing that over the next few years.
Yeah, there's a book that's 10x is easier than 2x. And the guy makes the case, is it easier to double the size of your business or 10x the size of your business? Most people would say it's easier to double. And he says, no, it's actually much harder because you actually have to spend, if you're working 40 hours a week, you got to work 80 hours a week, and you got to do just more of what you're doing. Yeah. But when you 10x, you got to let go of about 80% of what you're doing. And you kind of described it. You actually have to become a different person. So people that go 10x, they're good at embracing a new identity, right? So you as a 7-figure Mauricio looks different as an 8-figure, right?
It's fun because I'm really trying to step into those shoes. I'm trying to think, not try, I shouldn't even say trying. I am walking around as if I'm an 8-figure entrepreneur. Like, what does an 8-figure entrepreneur do? They don't open their emails. They don't go by posts. Like, what does that person do? What do they read? Who do they listen to? What is their day-to-day habits? And that's really where I'm getting into. But yeah, it's a different skill set that I'm in the process of acquiring, and I'm looking forward to that journey.
Yeah, that's awesome, man. Well, I commend you for doing it. And I think, I look at people like you, and I think of leaders. I think of leaders like Warren Buffett and Mark Cuban and some of these guys. They read all the time, right? They find ways to invest in themselves and read and do more and more. And so I think the busier I get, the more I try to realize my part-time job is learning and reading and finding more to do. And so I love all the value you're adding, man. I always appreciate how approachable you are and how kind of straight shooting you are. I encourage everybody to reach out to Mauricio, but appreciate you being here, brother. And we'll hopefully have you back here again soon. And wish you the best on the travels there. And thanks for joining the Mailbox Money Show.
Thank you for having me. Appreciate it.
Thanks, man. All right. So love this interview with Mauricio. Love how down to earth he is. And again, coming back to just some of those things of investing in yourself, really, choosing to learn the lessons, to reflect, to not stop investing. If you have one deal that goes bad, it doesn't mean investing is bad or that you're not good at investing. It just means there's a lesson there. And so the story of the example I gave, where you had 2 investors that had lost over $1 million each, but each of these people were worth, a lot more, over $10 million. There's a high net worth each of these people had. And so, they use it as education. And I've used losses in my life to really educate and help to not define, not say, oh, I'm a failure, I'm a success based on how something goes, but everything is learning and everything is education. So my hope is that for you, friend, that you learn, that you grow, that you invest in yourself, no matter how things go, and that you will continue to get better and better. Just like my book, Fire Yourself, says, that you can learn to become a better and better investor, and you will grow with it. So I hope you enjoyed this. Love to hear any comments. Love for you to share this, and feel free to reach out if there's any way we can help you. If you haven't joined our investment club, love for you to join that and hear about some of the unique deals that we're doing. We look forward to catching you on the next episode of the Mailbox Money Show. You've been listening to the Mailbox Money Podcast. For more free resources, articles, and videos, go to BronsonEquity.com. There you can download your copy of the special report, The Single Best Investment Strategy During and After a Pandemic. None of the information shared here is an offer to buy a specific investment, and this is for educational purposes only. Consult your financial, legal, and tax professionals and use your own common sense before making any investment decisions. Thanks for joining us, and be sure to tune in next time for more Mailbox Money.